Okay, so for today, I want to take you through a couple of examples of the supply and demand model and application, right? So we're going to take a look at two different markets, and in each market, we're going to see an example of an application of the supply and demand model to distortions, specifically from interventions in the market that aren't normal occurrences, but are interventions meant to distort the functioning of the market and specifically to stop the equilibrium price from being achieved. So, first one we're going to look at is the fictional stock market for shares of JP Morgan and Chase. And what you can see here is that we have our typical breakdowns that would be associated with the demand with the supply and demand model. We have a demand schedule, we have a supply schedule. The demand and supply schedules give us the quantity of shares demanded or supplied based on what the share price would be in the market. And to get an idea of what the fair share price would be, right, we would have to consider a few things. First, JP Morgan Chase is not a sole proprietorship. It's not a partnership. It's a corporation, right? It's organized under corporate legal structure. Um, Under that structure, it has public shareholders, and those public shareholders basically own a piece of the company to the extent that they have a right to a certain proportion of earnings. That proportion being equivalent to the proportion of their stock value in comparison to everybody else who owns shares in the firm. So, to begin, for a corporation, we would have to know what their fair share price is to even get to an idea that there might be a equilibrium market price. This isn't the traditional way necessary of analyzing stocks to find out what their fair price is, but we can effectively build a smaller model here in the middle of our sheet that effectively looks at the fair price of a stock being a function of the future value of retained earnings per share and the future value of dividends per share. So I basically ran some future value formulas on these two values. For value of retained earnings per share in the future, I put the average retained earnings per share for the next 4 quarters would be about $1 per quarter, and that the average dividend payment per quarter for the next 4 quarters would be 5 cents per share. And then, using it's really just not essential assumptions about what the interest rate would be. We can come to the conclusion that the fair price for a share of JP Morgan and Chase stock based on this would be $4.26. And what we can see in the demand schedule is that yes, indeed, at $4.26, we have 100 shares demanded and 100 shares supplied, which may not be what happens in the real world because clearly more than just the retained earnings and dividends value go into informing traders about what they think the fair value for a stock would be. But in our simplified model, we make the assumption that at least the supply and demand part of the pricing would be equivalent. That at $4.26, it should create a equilibrium market where all the shares that would be demanded are satisfied by all the shares that would be supplied. Now, you can see a few other things here that are pretty typical because of the law of demand, right? The demand curve slope is negative, and the supply curve slope is positive. I have here incorrectly labor supply. I should put in that it is shares, but bear with me and assume that says share supply slope and the shares demand slope. And then we have the elasticity, which we could adjust if we wanted to show a market where changes, shifts of the curve would have more dramatic effects. So if we were to, for example, make the price elasticity of supply a little bit higher, it would change the slope of the supply curve. For example, let's make it 0.8 and see what happens. And what you could see happening is that the slope becomes a little bit flatter. If I was to make it 0.1, it might be more noticeably, yeah, there we go. So we can change the slope of the curve, which would have an impression upon what changes in shifts of the curve would do to the equilibrium price. But we won't even get into that right now. Let's just get into the idea of how this might be distorted just looking at, for example, a price floor situation. So in our example here, we're going to have a price floor that is created by a stock buyback. So I have example 1 in this cell, securing the bag, price floors through stock buybacks. As the CEO of JP Morgan, part of your compensation is paid in the form of performance shares, which in this agreement are a predetermined number of JPM shares you will be given for hitting certain business metrics. Because the numbers of shares is constant, the only way you can ensure the size of your compensation is to ensure JPM stock price doesn't go below a certain value. And you'll do that by effectively creating a price floor in the market for JPM shares through stock buybacks. Having the company buy shares off the market if the price threatens to fall below a certain threshold. Through stock buybacks, you know you can create a shortage in the market that will keep the price of a JPM share higher than its fair price, at least until your payout happens. So let's activate this example. And in this example, we want to see a situation where the target compensation is $25 million, which you would be able to see in cell K50. Currently, the projected compensation is $17 million. So what would happen if there was an attempt to keep a floor below the market price so that the price in the market never actually hits the fair price? Well, to do that, what would happen is that the firm, JP Morgan Chase, or I should say the CFO of JP Morgan Chase, would be instructed to organize a stock buyback where the company would literally buy shares of itself back from the market. And typically these stock buybacks have an effect in the market where the share price, at least in the short run, is elevated, both from the effect of a negotiated price for the stock buyback, which is usually higher than what the price is in the market. In this case, it's higher than the 426 because we're looking at 625. But also because the effect of a share buyback is that there are fewer shares on the market. And just by simple supply and demand, fewer shares should shift the supply curve at every given price point so that there are fewer shares available for sale at any given price in the market. And what we see is that indeed the supply curve has shifted to the left. And in shifting to the left, we have a situation where at every given price point there are fewer shares available. Even at 426, there's no longer the equilibrium. So now the equilibrium price point is probably higher than the 426. And if we were to just look at this graphically, we can see that yes, it is indeed higher. It is somewhere between $6 and $7 right now. It kind of makes sense if you were to look a bit at the graph here, that it would be somewhere between $6 and $7 as well. If we just want to adjust the price over here in the market, we can probably find out real quick how as close as it might be. Nope, not 625. Let's see, 624. And yeah, so the surplus gets closer to being zero the closer down we get in this price point, right? So if we were to go for 620, pretty sure we'd have, yeah. And if we were to just do 6, it would probably, yeah. So the price is going to be somewhere around the $6 range. In any case, it's definitely above the 426 because as we can see, if we were to just put 426 into the share price here, we would end up with a situation where there's a shortage. So what JP Morgan and Chase's CFO has basically done is that they've created a price floor. This is how price floors are in effect created in the real world. Even with government intervention, what typically happens is that the government may have a target for the price that they want to keep something from falling below, but they make that in effect happen by pulling the inventory of that good or service off the market by buying it themselves usually. And in this case, what's happening is that JP Morgan is deciding to buy the shares off the market so that the equilibrium price goes above 426 and instead climbs closer to the $6 range. That would be the creation of a price floor, because what you're doing is that if the price was around this point, you're creating a situation in the market where the price will never go below the floor of $6 because you will continue to buy the shares that would bring a shortage into the market. And by that shortage existing, the price in the market will naturally lift. The equilibrium price will lift because you're shifting the curve. If you're constantly shifting the supply curve to the left, every time the price starts to dip too low, you're just going to continue to go up this demand slope and continue to reach a higher level than what would be the case in a market without manipulation. The next and final example I want to show you is one with a price ceiling. And in this case, we're going to look at the market for British pounds. Now, this is what we would call a foreign exchange market or a Forex market. And in this Forex market, we're just looking at two different currencies being traded. We're looking at the US dollar and the British pound. So right now we have a situation, again, we have our demand schedule and our supply schedule showing us what quantity of British pounds would be demanded or supplied based on the dollar cost for the British pound, the dollar price prevailing in the market. Equilibrium in this case would be $1.31 for. At $1.31, you have 100 British pounds demanded and 100 British pounds supplied. That $1.31, by the way, implies $1.31 per pound. So as opposed to 43 cents per pound, where nobody wants to supply any British pounds, or $3.26 US dollars per pound, where very few people want to actually buy the British pound. What we have here is a situation where $1.31 seems to be the equilibrium point, where for $1.31 per pound, you have just the right amount of people willing to buy and sell a pound. We have the equilibrium price and quantity. Now, in this market, we're going to simulate the situation that would occur if the market was undergoing, or the British pound was undergoing something that we call bear rating. In Forex markets, bear rating is effectively similar to short selling. The idea with a bear raid, though, and the part that makes it problematic, is that the bear raid implies that there is a cohort, a group of people who are kind of conspiring with each other to keep the price of an asset below its fair market value, so that they materialize the gains that they were looking for by short selling the asset. So this effectively works in a way where people forecast that something is going to lose value in the future, and they take actions today that will make them profitable if that good loses value in the future. And yeah, if that good does not lose value, then they may actually lose money on the transactions that they took anticipating that. So an illicit approach, which is example 2, would involve getting a bunch of people who also have that good to start selling a lot of it at the same time to try to keep the price depressed long enough that your bet that the price would be depressed actually materializes. So in example number 2, bear rating the pound, price ceilings through Forex shorting, you're seeing some problems in the foreign exchange market for British pounds. You think the currency will fall in value under the weight of inflation in the UK and a shortage of foreign currency reserves. Because if the UK doesn't have any reserves, if they don't have any US dollars in reserve, then they won't be able to buy any pounds to keep the price of their currency elevated. But to ensure your forecast comes to fruition, you illegally assemble a cohort of traders also holding British pounds and start a coordinated plan to short the currency and keep the value on its desired trajectory. Shorting the currency means a cohorted plan to bet that the currency will lose value while you sell the shares of the asset that you have. So if we were to activate this example, which I'm going to activate right now, you can see that what happens is that the market now no longer finds equilibrium at $1.31, right? At $1.31, there's now a surplus of goods, of British pounds on the market. And that is because graphically, if we were to look where $1.31 is, right, that intersection is not necessarily anymore where the value of the currency would be. $1.31 may be like right around this region. And now we can see that the price of the currency actually seems to be hitting equilibrium marginally above that. Well, actually, closer to $1 if we were to look at the literal paths of the demand and supply curve in the thin lines. And you can see that in the schedule here that, yeah, it is closer to $1. So instead of $1.31, where 100 British pounds are demanded, but now there are 130 British pounds in the market because your cohort has started selling their pounds and they're starting to flood the market with supplies of British pounds. Now the equilibrium price has been pushed down to close to $1. And at $1, let's see if we could actually get this market to balance out here. I'm going to change the price in the market to $1.05. We got the shortage. What happens if we hit $1? How about $1? And let's just do like 3 cents or something like that. In any case, the target price now, the equilibrium price is much closer to $1 than where it was before with $1.31. And the result is that you end up with a profit of $9.3 million from your efforts, because what happened is that effectively through the bear rating process, through short selling, the traders, you sold 30 million pounds at $1.31 and then pushed the price down of the pound to $1 roughly, which leaves you with a difference that when multiplied over the amount of pounds you sold leaves you with a profit of about $9.3 million. I don't want to get too deep into the mathematics of short selling. That is more appropriate for a financial analysis course or financial investment course, but I did want to at least give this example because this is a version of a price ceiling. By selling these goods, by flooding the market with quantities of the asset being sold, in this case British pounds, the market basically ends up unable to reach equilibrium for the fair value because there's an artificially high amount of product on there. There's an artificially high amount of pounds on the market, and now the equilibrium price is constantly kept below its target, below where it would naturally have been. It's being kept closer to $1 right now rather than where it would be, which is close to $1.31. And by doing that, that's just effectively how pricing would be enforced in the real world as well, right? While there may be the literal situation of like rent control, where prices may just not be allowed to raise above a certain level, another approach to trying to keep the cost of housing down, for example, would be to just constantly build more housing as the price of housing reaches certain prices. Once it reaches a certain price, build more housing, and that extra capacity, that extra quantity of inventory on the market being live would bring the price down naturally. And in this case, that is what the short sellers would be doing. They keep the British pounds price down naturally using a price ceiling that they've created by selling British pounds anytime the price tends or threatens to go too high. So hopefully both of these examples give you an idea of how the supply and demand model can be applied to market distortions and market manipulations, specifically using the stock market and the Forex market. But of course, the textbook goes into various examples that effectively also take a look at what happens when prices are stopped from reaching their ideal levels or their equilibrium levels.